Welcome back to Financial Market Insights for Traders, where we break down complex financial and economic events into actionable insights for traders and investors. I'm your host, Sophia, and today we're diving into a topic that's shaping global markets right now: trade tariffs, trade wars, and the unintended inflation that comes with them. We've seen this before: nations imposing tariffs to protect domestic industries, only to end up with higher prices, economic slowdowns, and retaliatory trade measures that make everyone worse off. The world is once again witnessing the consequences of escalating trade disputes. And if you're a trader, investor, or business owner, understanding these dynamics is crucial to navigating market volatility. Today, we'll discuss how trade tariffs impact economies, the mechanics of trade wars, and their unintended economic fallout, why tariffs often lead to what I call mutually assured self-inflicted inflation, how financial markets react to tariffs and trade wars, and most importantly, how you can trade these market conditions to your advantage. Let's get started. The purpose of trade tariffs. First, let's break down what tariffs are and why governments use them. A tariff is simply a tax imposed on imported goods. Governments apply tariffs for several reasons. To protect domestic industries, tariffs make foreign goods more expensive, encouraging consumers to buy locally made products. To reduce trade deficits, countries with large trade imbalances impose tariffs to discourage excessive imports. To generate revenue, governments collect money from tariff taxes. As a geopolitical weapon, tariffs can be used as leverage in trade negotiations or as punishment for perceived unfair trade practices. Tariffs can be structured in three main ways: ad valorem tariffs, a percentage of the product's value, e.g., a 10% tariff on imported cars; specific tariffs, a fixed amount per unit, e.g., $5 per imported phone; compound tariffs, a combination of both. At first glance, tariffs seem like a logical economic tool, but history has repeatedly shown that they often create more problems than they solve. How trade wars escalate into economic chaos. When a country imposes tariffs, trade partners don't just sit back and take the hit. They retaliate, leading to trade wars where nations impose tariffs back and forth, each trying to hurt the other's economy. The problem? No one really wins. Let's look at some real-world examples. The Smoot-Hawley Tariff Act, 1930. This U.S. law imposed tariffs on over 20,000 imported goods to protect American farmers. The result? Other nations retaliated with their own tariffs, causing a collapse in global trade and worsening the Great Depression. The U.S.-China Trade War, 2018 present. The Trump administration imposed tariffs on over $360 billion worth of Chinese goods, and China responded with tariffs on $110 billion in U.S. imports. The consequences? U.S. businesses paid more for imported materials. China's economy slowed due to reduced exports. Stock markets experienced massive swings based on trade negotiations. Global supply chains suffered, raising prices for consumers worldwide. Trump's 2025 trade tariffs. And now here we are again. President Trump, in his second term, has reignited trade wars with new tariffs targeting Canada, Mexico, and China. 25% tariffs on Canadian and Mexican imports, 10% additional tariffs on Chinese goods, doubling some tariffs to 20%. The stated reasons? National security concerns, accusations that Canada and Mexico aren't doing enough to stop drug trafficking, illegal immigration, pressure on Mexico and Canada to enforce stricter border control, economic protectionism, prioritizing U.S. manufacturing and reducing dependency on Chinese goods. The immediate effects? Retaliation. Canada and China have already announced counter tariffs on U.S. products. Market volatility. U.S. stock indices have been swinging wildly in response. Rising consumer prices. Tariffs drive up costs, which get passed down to consumers. Mutually assured self-inflicted inflation. This brings us to one of the biggest unintended consequences of trade wars: inflation. Here's how it works. Tariffs make imports more expensive. Businesses pass higher costs to consumers. Consumers pay more for everyday goods. Inflation rises. The central bank raises interest rates to fight inflation. Economic growth slows down. It's a vicious cycle that ultimately hurts the very economy the tariffs were meant to protect. Countries think they're hurting their rivals, but in reality, they're shooting themselves in the foot. Hence, mutually assured self inflicted inflation. How financial markets react to trade wars. When tariffs and trade wars dominate headlines, markets go into turmoil. Stock market volatility, trade sensitive stocks, tech, autos, and manufacturing experience sharp swings. Currency movements. Countries hit by tariffs often see their currencies depreciate. Commodity prices, tariffs on raw materials, steel, aluminum, oil, push prices higher. Bond market reactions. Investors move into bonds as a safe haven during economic uncertainty. For traders, this volatility presents massive opportunities. How to trade the impact of tariffs and trade wars. If you're an active trader, trade tariffs can create high profit potential in Forex, commodities, and stock markets. Here's how to position yourself. Follow economic announcements, monitor government tariff policies, diversify your portfolio, reduce exposure to industries heavily impacted by tariffs. Trade currency pairs, Forex traders can capitalize on exchange rate movements. Invest in commodities, tariff-driven price spikes in metals and energy create trading opportunities. Use stop-loss orders, manage risk effectively in volatile conditions. If you want a powerful trading platform to navigate tariff-driven market swings, check out crystalballmarkets.com. With real-time news alerts, advanced charting tools, and access to Forex, stocks, and commodities, all in one place, you'll have everything you need to trade global market disruptions effectively. Final thoughts. Trade wars are a lose-lose game, but for traders who understand the market's reaction, they can be an opportunity. By staying informed, managing risk, and leveraging volatility, you can turn trade-driven uncertainty into profit. That's it for today's episode of Financial Market Insights for Traders. Don't forget to subscribe, follow, and share so you never miss an episode. And if you're ready to trade these market moves, visit crystalballmarkets.com to start today. Until next time, trade smart, stay informed, and keep your portfolio ahead of the curve.